Welcome back to another week of what we have yet to define the name of, maybe AMO Weekly, maybe not. You are joined by Jacob Donnelly, founder of A Media Operator, and Christiana Shadone, reporter, editor, wonderful person here at AMO who continues to roll her eyes at me. We're still figuring out what the show is. We're figuring out what we want to talk about, how we want to do this. Over time, we will bring guests on board. But to those who are already listening, welcome to the journey. So, way this show works, if you weren't here last week, we're going to talk about a few of the main topics from some of the stories we've written, some of the things that we've observed, and we're going to go from there. So, without further ado, Christiana, I turn it over to you.
I'm very excited about this one because, Jacob, you're so rarely wrong, but I think you were wrong about The Athletic. So the Times reported earnings, and The Athletic was really the star of the show. And you had thought it overpaid. The Times overpaid for The Athletic back when it bought it. And it was a money loser for a long time. But things seem to have turned around. Tell me about being wrong.
So, I was wrong about the New York Times' reason for buying it. I might have even been wrong about the price. I'm less sure I was wrong about the price. So, was it 4 years ago, I think, 3.5 years ago, New York Times buys The Athletic, probably at the peak of M&A in the media space, paying $550 million in cash. Once you factor in how much it's lost over the years of the New York Times trying to get it to profitability, it's 625 million total. And when I looked at that deal, the valuation of The Athletic was egregiously too high. Like they couldn't get to profitability. They had an interesting model, the theory of subscriptions for sports content, when very few people were doing that. But I remember there was another operator who once referred to it as the WeWork of media, right? Would never have been able to live up to its valuation. But what I underestimated about the business was not only would it allow them to bundle the subscriptions more and kind of get a better, news, games, the affiliate with Wirecutter and sports into one mega bundle, I underestimated the advertising potential. I had a reader after I published this who likes to remind me where I'm wrong. He said the reason The Athletic was purchased by the Times is because it unlocked alcohol advertising. You had never seen like a beer or alcohol ad on the New York Times before, and then suddenly you were now seeing this because they were able to sell The Athletic and the Times as like a cross bundle from an advertising perspective. And so it unlocked a massive new category of advertising that just didn't exist before. And if you look at the financials, like the ad business is, what was it up? Like it was up like 80%, I think, if not a little bit more, a little bit
Yeah,
less.
yeah, it was a big jump.
It was a big jump. And so like that's driving a lot of its revenue growth. Yes, the subscriptions are growing, but much slower than that ad business is growing. And so now, at least on an adjusted basis, it's profitable. Like that puts it in a very good place where now the Times has time. Now it's not burning cash on this. It's seeing growth. I think the ultimate question with M&A, and it's when we look at M&A in a simplistic term, it's just should I buy or should I not buy? And the way that that's looked at is typically like, is it profitable? And am I going to generate a return of some sort? But for more advanced institutions, when they look at M&A, it's will I make more than I would have if I had done something else with that cash? And in many respects, doing something else with that cash as a public company is just returning it to shareholders. You buy back more of your shares, you do a special dividend. Like they had all this cash on hand. Like, could they have done something that would have been more accretive to the business? I don't know. So I was wrong in that this wasn't a mistake, especially for like a time horizon business like the New York Times, where like the Salzburger family controls everything anyway, with their with their special shares. But I don't know if it was still today like the best price they could have gotten. I think there were few companies that could afford what the Athletic got.
Do you think they could have grown that organically created an athletic without having to buy the athletic. They already had a sports department. They had plenty of sports reporters. Why not just build their own?
Yeah, so there's always that buy versus build debate. Um, and I think what it comes down to is ultimately time, right? Like, and this is something like when I thought about whether we should buy toolkits or not, I looked at how long would it have taken me to acquire, and this was a small asset purchase, how long would it have taken me to acquire 3,000 subscribers? And what would be the price if I were to go out and do it through social media or, social media ad buying or whatever? And I just concluded the time in which it would take to do that was longer than making the acquisition. And I think there's something similar here for the Times vis-a-vis the acquisition of the Athletic. This was I think they had 1 million subscribers when they bought it. Like, how long would it have taken the Times to get 1 million subscribers from a sports business, right? How much would they have had to spend to get there, right? The Athletic has one of the deepest benches from a journalist perspective in sports. Is it going to take them the Times 2 years to get there, 5 years to get there? And then you look at that opportunity cost of, all right, well, I bought this thing. 4 years later, it's profitable and contributing to cash or contributing to, overall, net income. That's a lot better than maybe in 5 years I could be at break even or something. So I think it's just like, there's putting capital to work expeditiously is sometimes a good thing. But this is why strategic finance people get paid a lot of money, because they can help model that out. I mean, I can't model that out. I'm not smart enough.
I doubt that, but in any case, let's move on to events. I was at CISO a few weeks ago in Austin, and I met a whole lot of people from events, the events business. And I recently spoke with one of them, Doug Emsley. He sold Tarsus to Informa for nearly $1 billion in 2023, and he's since been investing in different media and events companies. He's also one of the nicest person I've ever met. And was really, really forthcoming, talking about, his active investing in Raccoon Media. He also invested in Jacobs Media and has a minority stake in Easy Fares. He's looking at expanding in the U.S. And Jacobs Media in the Middle East, specifically luxury travel. He's about to launch a big new show, has something to do with supply chain, fashion, and recycling, something to that effect. And he's still really excited about the U.S. It's still a great market, even if things are a little difficult right now, complicated, challenging. He also, and I don't know where this stands right now because of tariffs, the tariff talk is constantly changing, but he did say he doesn't think we will see any tariff impact until 2026, if anything. And he did bring up CES as an example, which I thought was really interesting. So 40% of the exhibitors at CES in Las Vegas are Chinese. So even if the tariffs aren't as bad as one would have expected, it's probably going to be impacted. And he also said he's still seeing a lot of appetite from private equity and buying events companies, and so we should expect to see a lot of M&A coming up. Hopefully, it's picked up a little bit. Jacob, thoughts on Doug?
It's been boring.
It's been boring. It's picked up a little bit this year.
Look, I think there are not a lot of people in our industry who have built a company to nearly $1 billion, right? And I think he was group CEO of Tarsus for a long time, if not since the beginning. I don't entirely know. So, in many respects, that's kind of a gangster move. You got to respect it. I think my opinion on the whole tariffs and events and all of that has sort of evolved a little bit over the past few weeks. So obviously, since we're recording this on Tuesday, May 13th, there seems to be somewhat of a framework from a trade deal between the U.S. and China, or at least a 90-day pause on some of the extreme tariffs, which alleviates some concern from a recessionary perspective. But I think we need to look, when we talk about tariffs, we need to look at exactly that point Doug made about CES. What is the impact on international exposure to U.S. events? For a lot of U.S. events, there's actually very little international exposure, right? I read an article, actually it might have been this article, that was people are less likely to travel to like the big show of the year. Instead, they're looking for sort of regional things. So like if you're in Germany, you want to do something in Europe. If you're in the US, you want to do something in the US. We looked at Emerald, and Emerald doesn't see a ton of international lift to their US events specifically. I think like they looked at like it was something around 10% of their exhibitor revenue was like potentially at risk, of which like China and Canada and Mexico I think was 5% of the total pool. So like when I look at that, I go, okay, tariffs only matter from international to the U.S. They don't matter within the U.S. And so like for AMO, tariffs don't really impact us too much because most of our audience is here. I think the bigger risk is if we don't get things figured out with China and like this trade war does become hot again and we start to really lean in on that, what are the impacts from like a asset quality in China, right? Like Informa has a ton of assets in China. How much of China is dependent on like the Chinese market dependent on strong export businesses to the United States? And do those events start to struggle? So that's where like the tariffs become a big problem for some events companies is if you're dependent on a strong Chinese market to survive and that market is dependent on the US to be importing your goods, that becomes concerning. So for CES, is that at risk? Yes, but like CES has been at risk for a number of years now. Like I don't know if they're seeing a ton of growth like they did prior to the pandemic, similar to South by Southwest, right? I think there's an argument to be made that these massive trade shows that sort of cover everything don't have a place anymore. Like consumer electronics, what does that mean? Versus consumer
Everything.
electronics for one topic.
Yep.
Yeah.
Well, so this is
So,
actually this is
go ahead.
it's interesting because I just finished a story that I will be sending to you, talking about how a lot of show organizers are actually going to bigger events rather than smaller events because it's just more lucrative. But on the China thing, Clarion has also owns Global Sources, which is a huge event in China. It's like a month-long event, and it's about trade. As far as I understand it, the audiences for this show have been shrinking, and it's coming at a time where we have this China-U.S. complication, and Blackstone wanting to sell Clarion. So there's speculation that Global Sources is holding back a sale of Blackstone for Blackstone to sell Clarion. There's sort of mixed messages about it. It seems that some think they should spin it off, and others think that investors are smarter than that. They get that this is now. In the future, there will still be plenty of opportunity in China. What are your thoughts?
I actually don't think investors are smart. And maybe that'll irritate people, but like there are incredible businesses that because of just like the inability to spreadsheet it out, their minds explode, right? So early stage investors can be kind of smart, right? Because they have creativity and they see a future vision. But you get to like a later stage, it's just spreadsheets. So, not to insult our investor viewers, but like whatever. So let's remove that from the equation. Ultimately, like if that spreadsheet math is the game, then they're going to look at this shrinking part of the business. And I think you reported that it's like 25% of Clarion's total revenue is global
Yep,
sources.
exactly.
All right, so 25% is struggling. It's maybe not growing. It's sort of shrinking. So that's going to be a drag on the business. And so investors might devalue that a little bit, right? And so the question then is, how does Blackstone potentially split that apart, right? Because like as far as I know, that sort of growth problem already existed even before these trade wars, right? And so like that's going to be a drag, whatever the case, even if they do correct trade. So I think that Blackstone definitely wants to make a deal for Clarion. That's been reported now for, I think, for as
Almost a
long as
year.
you've been at AMO.
Yeah.
Yeah. Um, you know, Doug, in the interview did say that like Clarion is a very good asset, and he obviously has a good eye for what is a good asset. So I think the question is just going to be like, can investors see past that one big shrinking thing to understand the bigger picture? Does that, put compression on the multiple, right? Like big scale events companies can trade at pretty high EBITDA multiples, but if a quarter of your business is shrinking, maybe you get knocked down a turn. It's hard to say, um, but I don't think this is like existential. I think that they'll figure it out. You can always make a deal. That's the case. You will always be able to make a deal. It's just, will both parties be happy?
Possibly not. In other news, Dow Jones reported, well, News Corp reported earnings, but Dow Jones was the star of the show again. And I was just thinking it was interesting that News Corp is getting better results from going narrower, more B2B, more professional services. Then you have the Times is going wider, I think, more consumer focused with the games and the cooking. And I guess The Athletic is somewhat of a niche, but it's also, they cover all sports. So pretty consumer friendly. I just thought it was interesting to see the different strategies and both seem to be working for the companies. What are your thoughts on these different strategies?
Well, just to go back to my point about investors and their intelligence, News Corp is another great example of the inability to see the forest for the trees. And this is a business like News Corp itself should be trading at a much higher valuation. Like there's a reason there's a number of hedge funds that are saying that, but investors just can't wrap their heads around all the different components of this company, and so they apply a massive discount on the valuation. It's a similar thing to IAC, by the way, which we've written about. But anyway, that's not your question. I just wanted to make my point because I can. So comparing Dow Jones to New York Times, you can do one of two things in media. And this is the classic media barbell story. You either can be niche as all hell or big as all hell. You cannot be in the center. So the New York Times has reached the point where they are large enough that they can go as wide as they want to go, and their business is going to be good, right? And so they've got that core news business, and they've got games, they've got cooking, they've got sports. Like they are a mass scale consumer media business that monetizes with subscriptions. There's nothing wrong with that when you get to that scale. In some respects, also, though, they are just like the newspaper from 40 years ago, right? Like, you pick up a newspaper then and you look at it and you would see news, but you'd also have the crosswords in there. And, you'll have a sports section and, maybe there'd be a cooking section or a food section or like a lifestyle section. So, like, it's exactly the same model. And that's the thing that, like, no other news company, this consumer news company, has figured out is most people don't like news. We know this, right? And I was talking to another operator who did a survey years ago that found, like, he did a survey of another newspaper. And what they found was like news was like the ninth most important thing that users cared about. They cared about everything else, right? The jobs, sports, whatever, anything other than that. And then the news was there, and it sort of was, when you open a newspaper, you would get sort of like your dinner and your dessert kind of at the same time. Like, eat your potatoes first, then you can have chocolate cake. But when you can seek out specific things on the internet today, it's much harder to say news matters. So I think that's one of the things that the New York Times figured out was they took what worked in the newspaper and they just rolled it into a digital subscription. And so now you can get news and games and cooking and sports all in one subscription. So that was what worked for them. That's why they're mass scale consumer, and that's why it's going to be a fine business. For Dow Jones, they also have a mass scale like subscription with the Wall Street Journal. That is, well, I think it's something close to like 4 million subscribers, especially when you add in Barron's and Market Watch. And so, like, they've also got a pretty mass scale subscription business, and their subscription price is significantly higher than the Times. But I think what Dow Jones has realized is, at least on the B2B side, there's a ton of value in these like data businesses, right? And that has really introduced an opportunity for them to um, increase the value of that subsidiary, because a dollar for the Wall Street Journal, which is a monthly subscription and can be churned at any point, compared to a dollar for like their risk portfolio, investors are not going to value them the same. Um, and so I think that is the real thing that they've kind of figured out. And they've continued to make deals. I suspect they will make further deals over the coming years. They were certainly busier a few years ago when interest rates were lower. I suspect that might be factoring in, again, going back to the whole financial planning, borrowing money at 10% or whatever, like the going rate is for debt, might not be as lucrative as doing it for 4%, or it's definitely not as lucrative. But I would be shocked if they didn't buy other assets. I think what's particularly interesting about News Corp and Dow Jones is it's sort of like a tale of two cities at that business, where you've got Dow Jones, which is crushing it, and you got the news media division, which is kind of struggling. We're talking like the British newspapers, we're talking the New York Post. What was the traffic drop for the New York Post?
It was huge. It was like 40 million. It was 85 million unique users at the Post in March 2025 compared to 125 million in March 2024. That's a big drop.
That's huge. And I don't think that's going to turn around. I don't think there's something that the New York Post can suddenly do to get back to 125 million, right? And so, if they're going to start seeing that traffic drop and remain primarily an ads business, there's only so much tweaking and optimization that you can do, especially with the New York Post, which already has a lot of ads on the site. Like, there's only so much you can do, and at some point do those assets start to compress. Now, what is going to be interesting to see is can they figure out a subscription play, right? I think the New York Post, they still sell their newspaper print, but I think they're starting to figure out how to make their New York sports section its own subscription, which I'm a New York Knicks fan. We're recording this when the Knicks are up 3-1 against Boston. I love the New York Post's sports coverage. So are there enough people who might buy that? This might be one of those things where you have still a large scale publication that then monetizes off of like a subset of the audience. Whether they do that with the Sun or any of the other kind of newspapers they have, remains to be seen. But again, News Corp they're acquisitive. They'll buy their way out of problems if they have to. And I am curious to see how that plays out, but ultimately the Post is a classic example of like the era of traffic coming to an end.
It's too bad because the Post really does cover New York. I mean, hysterically a little bit, but the New York Times doesn't cover New York. Sometimes. But the New York Times doesn't cover it. The Daily News, I don't even know what's going on anymore there. No one ever talks about them anymore. There are a lot of different newsletters and, smaller homegrown sites that are dedicated to covering New York. But the Post has a reputation, for better or worse, but people know it. And, they could really, they could niche New York, which is what they should be doing. And they do to some extent.
Sure.
It's just
how many New Yorkers are there?
9 million.
Okay. They have 85 million unique visitors in March.
I know. I did the math, and I'm sure that includes, but okay, fair.
So it includes Long Island, it includes New Jersey, like you factor in, but at the end of the day, the New York Post fell into the trap that every digital media business did, which was just go mass scale, right? And so like they cover things, they want as many Americans coming to their site, not just New Yorkers, and for them to like repivot that and focus again on New York, they're going to have some work to do there, and they're going to have to accept a smaller business, which definitely will depend on that, will require them to depend on subscriptions even more, right? Like the business works really well now at mass scale, or as well as it can. But what happens if it goes to 50 million? They lost 40 million year over year.
Yeah.
Right.
It's wild.
So, but that's why it's a tale of two cities, right? You got Dow Jones, which just is crushing it across the board, right? Wall Street Journal is still growing. The B2B division, is still growing. Like everything is growing nicely there. And then you've got news media that's struggling. So the real question is, when does Dow Jones get sold?
We'll see.
Guess we'll see.
All right. Thanks, Jacob.
Well, that's all we've got time for today. Christiana, wonderful chatting with you. For everyone else, thanks for listening and watching, or whatever you're doing when you're engaging with this content. If you liked it, let us know. Shoot us an email, jacob@amediaoperator.com and christiana@amediaoperator.com. That's not Christina, that's Christiana. And leave a comment, like, subscribe, and we will see you next week.